It is a privilege for me to be here, and I would like to thank you for inviting me to this event. When I saw the invite, I said I should do everything possible to attend, because just a few days before, my son told me he was accepted to the Smith School, Business School, and I said, "Where is that?" But he's now considering where to go. He's sifting through his offers. So I said, the first thing I'll do before the college visit is to come and meet you. More seriously, it is an honor and privilege for me to address you and discuss macroeconomic outlook for the continent of Africa, but also discuss with you what it would take to really boost private investment in Africa. On macro outlook, I think what I'm going to be trying to do is, two things. First, we'll look at those, recent trends and discuss the growth outlook. But I will most importantly focus on discussing how to unlock the investment potential for Africa, especially because we are starting from extremely low level of private investment, and how it is important to continue reforming the investment climate. And finally, I would want to insist on why we really need new approach to investment, but also new approach to development financing. So let me start with recent macroeconomic trends. The slide you see here is basically pointing to the collapse in growth that took place in Africa in 2016. But before we focus on the collapse, because I'm sure you have already read so much about the end of the Africa Rising narrative, the end of the Africa, the African economies growing fast. I know you've certainly read or heard a lot about it. But before we get into that discussion, I would like you to picture that in the past 2 decades, the African economy has actually quintuple of its size. The African economy size has been multiplied by 5 since 2000. In 2000, sub-Saharan Africa, and I want you to know when I'm speaking of Africa here, this presentation is going to be only about sub-Saharan Africa, because that's how we partition the work at the World Bank. Sub-Saharan African economies represented a total size of 300 billion in 2000. By 2017, that size had risen to 1.6 trillion. So it's a small but expanding and fast expanding market. The second thing I want you to know is that before 2013, the average growth for African economies was 5.4%. And for almost 2 decades, our economies have grown extremely fast, and growth in Africa was only second to China. And what you see on this chart is that from 2014, because of the collapse in commodity prices, average growth in Africa came down to the lowest in 2 decades, to 1.3% in 2016. The red line you see is African growth. I think, let me come, that's right. So the red line here is Africa. And you can see that we have reached the lowest in 2016. But since then, the continent has been recovering. It is a slow recovery. It's a very, very modest recovery. But our outlook for growth for 2018 is actually very positive. We are now projecting that sub-Saharan Africa will grow at 3.1% in 2018, and probably around 3.6% between 2019 and 2021. So this may not be, the same level of, at the pre-crisis level, but this is actually very important because it's only in 2018 that per capita growth would become positive again in Africa. The high demographic growth in Africa is basically, has the consequence of lowering our per capita growth rate. And, population growth in average is like 2.6%. So, when we grow at 1.3% as we did in 2016, that means basically that we are actually experiencing negative per capita growth rates. So the good news is we're recovering, and we will certainly reach positive territories again. But probably you should notice that, if you project growth beyond 2018, Africa will be the fastest growing region in the world, higher than China, higher than the rest of the world. So what we want to show is basically that, we have gone through this dip, for sure. But the most important point is that, growth is multi-speed in Africa. And I know we are in a country where some people still believe Africa is one country. But I think it's important to know that when we say growth in Africa, the average is actually, hiding a huge heterogeneity. Just on this slide, if you look at the right panel, this growth rate is determined essentially by three countries: Nigeria, South Africa, and Angola, which together make 60% of Africa GDP. So when growth, collapses in Nigeria, Angola, and South Africa as it did in 2016, the rest of Africa may still be growing extremely high, but these three countries actually pull the average down. This panel is basically showing you that if you exclude these three countries, the rest of Africa is still growing above 4% and will soon match the level of pre-crisis average growth. So when we discuss average growth in Africa, we need to very quickly move into disaggregating and focusing on either regional or country level growth. I think that's extremely important. Now, to push this even further, what you see here on this chart is that it's just not, about South Africa, Nigeria, and Angola. You can actually, have 5 broad categories of countries in Africa. And to get that, to get this chart, what we have done is to compare average growth between 1995 and 2008 with average growth between 2015 and 2017, which is when Africa was actually going through the worst crisis of the past 2 decades. So what you see on this chart basically is that there are 5 groups of countries. The first group of countries that we call the established performers are countries that were growing fast before the crisis and are continuing to grow fast after the crisis. So these are Ethiopia, Tanzania, and Rwanda. These are our top performers. These are our established performers. These countries were growing at above 5.5% before the crisis, and they are continuing to grow above 5.5% after the crisis. You have a second group of countries that actually took the opportunity of the crisis to accelerate growth. These are our improved performers: Cote d'Ivoire, Senegal, Kenya, Mali. These countries were actually growing, slower before the crisis, and they actually sped up because they are net importers of oil. When commodity prices collapsed, especially when oil prices collapsed, net importers of oil could actually take advantage to grow faster, and that's what happened with these countries. Now, the third category of countries is what we call countries stuck in the middle. They're growing, certainly above 3%, but never exceed the average of the continent. So most of the countries are in this category. My own country, Cameroon, is somewhere there. But what I want you to notice is among our established and improved performers, there is no oil-dependent economy. There is no natural resource or extractive, precisely, dependent economy, which may tend to make the point that extractives have actually been a curse on the African continent, not a blessing. In fact, what you see in these two other bubbles are countries that are extremely rich in those resources. This is Angola, Nigeria, South Africa, Botswana. All these countries, Chad is even here, way negative growth. Republic of Congo, Gabon, all these economies that are single commodity or based on extractive have actually underperformed and pull the average growth down. Now, you'll not be surprised, based on our top two categories, that 6 of the 10 fastest growing economies in the world remain in Africa, which is the other message that is extremely important when you look at macro performance in Africa, is resilience. The idea that the continent is collapsing, is the dark continent, as the economists all, so once call it, that idea is actually not correct, right? 6 of the 10 fastest growing economies in the world remain in Africa. And in fact, from this chart, you can see, Ethiopia would probably be the fastest growing economy in the world next year. So, when discussing growth in Africa, I really want you to make sure you always bring this to the level of, heterogeneity that characterizes the continent, that you focus on country-level growth, that you focus on regional growth, but most importantly, that you make the distinction between resource-rich and non-resource-rich countries. Another way to say diversification matters, right? Economies that are more diversified tend to be more resilient, as we have seen through this crisis. Now, if I may look at a couple of macro indicators, what we've seen since 2017 is a recovery in commodity prices. Commodity prices have been recovering, and in fact, there is only one commodity whose prices have declined since 2017, and is cocoa. Cocoa's prices have actually declined, but most of the rest of the commodities have actually increased, and oil has recovered. We have seen a 67% increase in oil prices since 2015. We've seen an increase in metal prices, and agricultural prices, agricultural commodities prices have all increase. Now, if you look at inflation across the continent, it's rather a good news story. Inflation has slowed down across countries, in Africa, and the only country where inflation remains, the only large country where inflation remains above 20% is Angola. But it's actually coming down from 40% a couple of years ago. So inflation rates have certainly, been reduced, and exchange rate has also stabilized significantly. If we move to the current account, what is also quite evident is that, current account deficits have been narrowing in Africa, although they remain quite high. And, fiscal policy should, and has to really remain tight, because countries, especially those in Central Africa, countries in the CEMAC region, who were the hardest hit by oil price collapse, have started fiscal adjustment, but it's probably not reaching the desired outcome yet, and those efforts needs to be sustained. Now, overall on the continent, the fiscal space remains tight. And I, caught the tail end of Dr. Saye's speech on domestic revenue mobilization. I think that's an important point. Countries need, fiscal space to actually, implement the reforms that they are hoping to implement. So it is important, but what is happening is that, with debt rising, which is certainly one thing that keeps me up at night. With debt rising, fiscal space has been tightening, in almost a dangerous way. And I'll say a couple of words about debt because, couple of years ago, just in 2013, the average debt to GDP ratio for sub-Saharan Africa was 37%. And remember, we're coming down from an era, early 2000s, where we got debt relief, where most of these rates fell below 10%. In 2013, the average was 37%. And by 2016, that average debt to GDP ratio was 56%. This is probably not, alarming because, at the IMF and World Bank and, we generally tend to get alarmed when it crosses the 70% GDP. But if you look at how fast debt has been growing, countries like Angola have actually doubled their debt in 3 years. The pace at which debt has been rising is certainly a serious issue. The second issue is the structure of debt. It's not the early 2000s anymore. This time around, debt is actually not driven by concessional debt. It's driven by sovereign issuance on the Eurobond market. It's driven by private debt. It's actually driven by shorter maturity debt. So when you look at the repayment schedule on Eurobonds issued by all African countries, by 2014, there's more than $7 billion due on Eurobonds. Where are countries going to find those resources to service the debt is my nightmare. So we need, to continue working with our countries for fiscal adjustment, to continue for domestic revenue mobilization, to continue to ensure that debt remains sustainable. Don't get me wrong, not all debt is bad, as you know in this country, right? But if you are borrowing on a 10-year maturity to finance your infrastructure, you got a serious maturity mismatch. You know that. There are some currency mismatches also when it comes to some debt in some of our countries. So, we need, and from my perspective, the rising debt remains one of our, downside risks moving forward. Now, let me probably move now to discussing investment. Now, it's not unrelated. Countries need to invest in infrastructure, and as you know from literature, public investment in infrastructure is complementary to private investment. So our countries have been struggling, and some of these countries, some of this debt has actually been used to finance infrastructure. But overall, private investment remains extremely low in Africa. And, the chart you have here is basically showing you that sub-Saharan Africa remains the most undercapitalized region in the world. And, if you compute investment per capita, physical capital, if you want, per capita, that number is less than $2,500 in Africa, in sub-Saharan Africa. And it's more than half of what it is in the rest of the developing world. Then why is it that, and I spent half of my career working on East Asian countries. A stark difference between Africa and East Asia is these countries actually managed to build infrastructure in the 70s and 80s on which the private sector has been actually, that the private sector has been leveraging. In Africa, it hasn't happened. So if you look at this chart, what it's showing you basically is that, countries in green are those for which, investment is more than 20% of GDP. So we get roughly 5 countries, not more. So how do you grow when you are not investing? Basic ICOR, basic, investment multipliers, incremental output, capital output ratios, we all computed when we were studying economics, Well, how are they going to play here? Not that sure. Now, if you go to a specific component of private investment, which is public-private partnerships, they are not happening as much as they have in other parts of the developing world. Public-private partnerships remain low. And yes, there are still a number of countries that are doubting the idea of actually bringing in the private sector to complement the efforts of the public, And for some of us, we may be surprised if we're born in the US, but if you are born in a country like Tanzania, where you grew up in, with this, the mentality, the ideology that, the private sector is the enemy, it's not that easy. And in some countries in Africa, yes, not all private sector has been good. And we have to be honest about it, right? In number of countries, we are seeing actually, practices from the private sector that would push the populations to be entrenched in that ideology that you have to be careful about the private sector. And that's a serious issue. So, we need to address the issue of the regulatory framework for public-private partnerships to take place to be more dynamic in Africa, for sure, but the private sector has its own role to play. Now, if you break down investment in Africa, what is quite interesting is that, most of the FDI, the foreign direct investment that comes to Africa, is unfortunately concentrated in extractives. And my colleagues and I are looking now at AGOA. You certainly have heard of AGOA, the African Growth and Opportunity Act. And we are looking at exports that have benefited from AGOA in the past 10 years, and unfortunately, it's extractive. There's only one country, Lesotho, that has managed to increase its export of manufacturing to the US from AGOA. So AGOA, again, has actually entrenched Africa in its, comparative advantage of exporting raw minerals or raw oil. So as businessmen, business school, faculty, students, we all have a responsibility here to see what we should do to ensure that private investment that goes to Africa is, diversified, is also in non-traditional sectors. And what is interesting is actually extractives are a capital-intensive sector, so they don't create that many jobs for the African population. So increasing private investment in non-traditional sectors, in manufacturing and in services, would have a better prospect of creating jobs for the African population. Now, FDI has been increasing recently, but it is still very low. And I think the next couple of slides that I'll show would be, asking ourselves, what is possible to increase or to maintain those rising trends. And one thing that is really important is to reform or continue reforming the investment climate. And the next couple of slides I'm going to show you are about doing business in Africa. You've all, I'm sure, heard of doing business, right? Some, good press, some not that good recently. But the bottom line here is that Africa will not attract more investment without an improved investment climate. And doing business is just one way to improve the investment climate. It's not the whole story. And by the way, it's a limited number of indicators, right? But it is an entry point. It is one way to really start creating the condition for the private sector to thrive. So the slide you see here are basically countries, that in our new methodology, basically are, close or farther from, the frontier. And what you see here, basically, if you look at our rankings, number of African countries are actually, in the bottom category of, in the ranking from 153 to 190, the light blue category, right? Most of Africa is in the light blue category, which is the bottom ranking of doing business, which means countries are really, far from the best practice in that particular, in those indicators. So, but you do have a number of countries where, you're having an improvement that is taking them, the darker, as you can understand, the darker, the better, in doing business ranking. So you do have a group of countries that are certainly pulling ahead, and we need to continue those reforms. What is absolutely clear is that we are far from the frontier, but we are improving, and we are improving faster than the rest of the world. If you look at the change in doing business ranking in African countries, that's where you have actually seen the sharpest increase, right? So we're far from the frontier, certainly, but we are catching up. So this slide is basically showing you the distance to the frontier of each economy, and what it represents is the best performance observed on each of the indicators across all economies in the sample. So we have the widest gap to the frontier, which is 57 percentage points. But again, as we discussed during the earlier on growth, there is a huge heterogeneity across the continent, and we shouldn't, again, give one score to Africa as it was a country. So this is the comparison with different regions of the world. As you can see here, as Sub-Saharan Africa is certainly experiencing the highest, the highest change in doing business compared to other developing countries. So we are certainly, working hard, and the World Bank is working with countries to ensure that those reforms really are sustained. Because it's one thing to change the regulation, it's another to actually implement that regulation in a sustainable way. A number of African countries have great laws on the books, right? But taking those into implementation and sustaining implementation is certainly an area where we are working with countries to achieve. So, one specific area where reform needs to be really deepened is in the area of infrastructure, as we mentioned. And if you take access to electricity, you see, Africa remains one of the regions with the lowest access to electricity. The average access to electricity, the average rate is 37%. That is, 2/3 of the African population do not have access to electricity. And that rate is probably below 10% in countries like Burundi. So it's good to be discussing investment, private sector promotion and development. It's hard to think how it will happen if you cannot actually run an engine, if you cannot even have light in your factory. So it is important to continue, and in the Africa region of the World Bank, we have made access to electricity one of our priorities. We've been working extremely hard, including with development partners, to ensure we increase access to electricity. But this is one of the areas of the investment climate where we still need a lot of efforts in Africa. Now, I think what I've said early, what I've done so far is to say, well, there is hope. The continent is rebounding. Yes, growth is still quite modest. It is rebounding, but we would like to continue those reforms. We'd like to increase investment to probably come back to the pre-crisis level of growth in Africa. And that's when we will be able to sustainably reduce poverty. Now, what is absolutely clear to my mind is that business as usual will not take us there. Why? Because when you think of why investment is so low in Africa, it's not about the return. We have done studies at the World Bank that actually show returns are higher in Africa than other parts of the developing world. So why is it that it's so difficult to get investment to take root in Africa? One of the factors is perceived risk. One of the reasons why investment is so low in Africa is, and I do have slides that I can show you here, perceived political risk in Africa is actually exaggerated. Perceived risk, total risk, is also exaggerated. So it won't work for us to just continue here talking about the basic reforms, investment climate. There's something else that needs to be done. And I believe there are two things that we need to do. The first is to work as a global community to break that vicious circle where investors are told about huge risk in Africa and basically refuse to invest or believe it takes just so much, right, to invest in Africa. And the continent on its own is actually reforming, as we have seen, yet investment is not coming. Countries like Rwanda have been the top reformers on the doing business scale, but that investment is not coming in a commensurate way, right? So as a global community, we need to actually work to bring in new finance. We need to work together to actually mobilize private capital to invest in Africa. That's what the World Bank is trying to do, and we're calling it now maximizing finance for development. Others call it cascading. Now, we need to work together because pension funds all across the world have several trillion dollars that are rewarded at less than 1%. You have in Africa an environment, a growing market where returns are way higher. And if we could work together and institutions like MIGA, the Multilateral Investment Guarantee Agency, part of the World Bank Group, is actually doing that kind of risk analysis to convince investors that the risk is actually not unbearable, that we can actually help by guaranteeing some of this investment for you to bring that money in Africa. So that's one. And it's a global effort we all have to do. But the second thing we have to do to address that issue is embracing innovation. It's not going to work if we think of investing in Africa just as, bringing the old machinery of the 70s, to reproduce what Korea did in 1970. It's not going to work. And it wouldn't be wise because the pace at which technological change is happening is actually positioning Africa for what we call leapfrogging. My team and I just published this book on Africa leapfrogging, and we believe we need to pay attention to this because if you take access to electricity, building power lines will have to continue, but in parallel, we can leverage the revolution that is happening in solar. And solar is actually becoming cheaper and cheaper. And the latest bid that we had on solar farm in Zambia was 7 cents per kilowatt. Compare that to 45 cents per kilowatt Tanzania had to suffer burning fuel to produce electricity. If we leverage innovation in the area of electricity access, we can actually leapfrog. Take agriculture, where the sharing economy is actually already taking place in Africa and in agriculture. Companies like Hello Tractor, I don't know if you have heard about this, but Uber-like services are now penetrating agriculture. A farmer in Nigeria can now, on his or her cell phone, call someone with a tractor in the neighborhood to come and plow that land for an hour and pay through mobile financing on the cell phone. It's happening already. So when we think of investment, I want you to think about those constraints as business opportunities. I want you to think of investing in helping Africa leapfrog. And I think if we do that, then there are plenty of opportunities in Africa. And in fact, Africa will be and will continue to be for a long time the fastest growing market because of its demographic dividend. So if we work together, I think Africa will be and remain the ultimate frontier. With the Continental Free Trade Agreement being signed, with innovation taking root across the continent, with economic growth rebounding, and with fiscal adjustment continuing, I am certain the environment for investment in Africa is going to be the best moving forward. Thank you so much.
Hi, Dr. Zeufack. Thank you so much for speaking to us today. You actually, first of all, my name is Rafi Sol. I'm the president and CEO of Kiakle Technology Solution. As the dean was speaking earlier, we are one of the companies that has been selected by the Smith School to go to do the global consulting strategy. So we are going to Tanzania in May. So we've identified a couple of issues like lack of business skills in labor and all those things. So we're going to Tanzania to kind of see what's going on, how we can help in teaching and training, especially taking the business framework over here that are succeeding over here and then implementing in different countries in Africa. So you've touched a lot of points that really a big priority to our business in our entrepreneurship program that we want to implement in Africa. But one question that I have is, as the World Bank is identifying and realizing that it's not only that Africa is actually growing, Africa is very exposed, they know what they want. So how is the World Bank closing the gap between when the U.S. investor goes to Africa, for example, and they meet, both parties meet, and they can collaborate on the same level? Because one thing that I noticed, and it's from both sides, the African guys feel like begging, and the U.S. folks come as a superior to It's like if I was actually talking to someone earlier. The first time I introduced myself, the person told me that, oh, we only give fundings to this type of company and that. There's this misconception like we always begging for fundings, but there's so many ways we can invest in Africa, not just by money. A lot of the diaspora came here to study. We can bring that brain over there and invest and teach and coach the workforce in how to use the business framework that works in here. How is the World Bank working in closing that gap or like eradicate that mindset in terms of entrepreneurship?
Thank you very much. I think it's important to, one of the things that I would I would like us to get from this presentation is that Africa is a market. Africa is an investment destination. Africa is open for business. I don't think you have heard me once saying aid, right? It's a business destination and companies can actually invest profitably in Africa, right? So it is important to start really discussing Africa beyond aid, right? And your point is correct, which is, we need to forge different kind of relationship based on, mutual and mutually beneficiary interest. And aid alone, actually, and I like repeating this, aid has never developed a country. And by the way, international institutions alone have never developed a country, right? But they have helped countries that wanted to develop to do so. So it is not just about us, or about, the US or, international institutions changing the dynamics. It's also on African countries to change that dynamic, right? If we're coming for business, it has to be for business. It's not, it's important for us to clearly position our countries to be better partners in investment instead of always, requesting, or even believing that aid is the only way that will solve our problem. And let me just give you one number. The global community has mobilized last year to replenish the IDA 18 fund, which is the concessional window for the World Bank. And that came up to $75 billion, 48 billion to be allocated to African countries. And that's a record replenishment. It's huge. But we have assessed that if you are to close the infrastructure gap in Africa, you need $45 billion per year. The 48 billion IDA are for 3 years, right? And that's a record replenishment. So if our countries only rely on concessional funding, we will never be able to close that infrastructure gap. And it is important for us to certainly work to attract other sources of financing, work with international institutions and other development partners to mobilize private capital to complement those concessional sources. So yes, I think it's important to change the dynamics. It's changing that relationship, changing the nature of that discussion that is key. Thank you.
Good morning. Thank you very much for coming to speak today. So my name is Tolu. I'm an international student from Lagos, Nigeria. And I've heard a lot of things today, especially about like how to boost the economy just in sub-Saharan Africa as a whole. Mm-hmm. But there are two key points that I haven't heard from either of the speakers. And since you're like the last speaker, I think I could just ask you this. The first thing that I haven't really talked about is like human capital. You talk about like physical capital. But what do you basically think, especially being like the senior economist at the World Bank, in regards to human capital development, especially in a country like Nigeria that has a very rapidly growing like middle class, not middle class, but middle-aged population, like 20, working class population. And two, what is the role of inter-African trade? That's something that I've noticed hasn't really been discussed, knowing that there's places like the ECOWAS, Economic Community of West African States, knowing that even in general, like the whole passport, how they're trying to make a whole African passport so that you can travel to each African country. What do you think is the role of those two factors in basically like economic development and growth?
Well, I think these are two very pertinent questions. One, human capital. Well, I ended my discussion on embracing innovation, right? But the key to innovation taking root in the country, in any country, is human capital. So it is crucial for our countries to really continue investing in education and health. And I know, and probably we were part of the problem in calling education and health, and I heard that in the previous session, social sectors. I think it's about time to change that concept. There's nothing social about education. Education is the engine of growth, and education will be the engine of innovation. So, not sure why investing in education is a social concern. It is investing in growth. It's investing in, the future. So, unfortunately, a number of African countries are not investing enough in education and health. But more concerning is that even for countries that are investing large portions, and some countries do invest more than 20% of their budget on education, the quality of education has been declining. So we've made a lot of progress in the past 2 decades in increasing access to primary and secondary education. But quality has been declining. And last year, the World Bank published a World Development Report on education, and we call for what we call a learning crisis. Kids are in classes, but they're not learning. And this is due to a number of factors that we don't have time to discuss here, but, it includes teachers, but in most cases, it's not about funding, right? So it is important to continue reforms and investing in human capital, because this is going to be the key. On trade, I did mention the continental free trade as being a step forward, a good resolution. Although, to be effective, countries would have to continue, reforms on, behind the border, all the barriers to trade that would still remain, non-tariff, because most of the discussion focus on tariffs, but we know in trade that non-tariff barriers are as important as tariffs. We know that the free movement of people is as important as tariff, and this is not, these are all, extremely difficult reforms that have to be, implemented for the Continental Free Trade Agreement to become a reality. But it is a great step in the right direction, especially in a world that is actually becoming more protectionist. And I think Africa has no choice but to move in that good direction, because intra-African trade, as you probably know, is extremely low. It's only 15%, which is only, of all the trade by African countries, only 15% is between ourselves. Now, if you exclude South Africa and the trade in the COMESA region, that number falls to 3%. So this is a huge untapped opportunity, and I'm absolutely pleased that the continent is moving into that direction. Thanks.
Thank you.